Every year, thousands of highly paid professionals try to beat the stock market by picking individual stocks. Most of them fail. Not by a little, by a landslide. And there's a report that proves it, published every single year. It's called the SPIVA Scorecard, Standard & Poor's Indices versus Active, and it compares actively managed mutual funds against simple index funds that just track the market. The results, year after year, are strikingly consistent. Over a 15-year period, historically more than 80% of actively managed U.S. stock funds have underperformed their benchmark index. Not most years, most funds, over most long-time horizons, tracked over decades of this report being published. Here's why that number is so surprising to people. These are professional fund managers, people with finance degrees, research teams, and access to information most retail investors don't have. And still, the majority of them can't consistently beat a fund that does nothing except hold every stock in an index like the S&P 500. There are a few real reasons for this. First, fees. Actively managed funds typically charge higher fees than index funds, and those fees compound against you every single year, regardless of performance. Second, trading costs. Active funds buy and sell more often, and each trade has a cost. Third, and hardest to admit, consistently picking winning stocks better than the overall market, year after year, is extraordinarily difficult even for trained professionals. An index fund does something almost boring by comparison. It just buys a small slice of every company in the index and holds it, with very low fees. And that boring approach has, on average, beaten most of the professionals actively trying to outsmart it. This isn't a fringe opinion, either. It's why Warren Buffett has publicly recommended low-cost index funds for most investors for decades, including in a famous bet where he wagered that an S&P 500 index fund would beat a hand-picked group of hedge funds over 10 years. He won. None of this means active investing never works. Some managers do beat the market over some periods. But the data says betting on being able to identify which ones, in advance, is a much harder game than most people think. 3 things to take from this. Check the fees on any fund you're invested in. They compound over decades. Look up how that fund has actually performed against its benchmark index, not just in isolation. And remember, the boring option has, historically, beaten the majority of the exciting ones. The most sophisticated strategy in investing might just be the one that requires the least effort to maintain. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.